Welcome everybody. Welcome to horizontal versus butterfly. We're going to have a fight to the death. We're going to pit the horizontal spread versus the butterfly spread. Okay, now this is we do these sessions because there is a lot of redundancy in options trading. And I don't know if any of you have got into this, but I remember when I got into options trading, this was back in like 1998, 99 when I started dabbling around. We did not have fancy software. You had to kind of hand calculate what the option symbol was going to be based on the month. Like A was January, B was February. That's how you had to calculate it. So now we have all this really cool stuff. And I remember when I got onto my very first options pricing calculator, I loved it, and I thought, oh, I'm gonna make my own strategies. Like people have made bull call spreads, bear call spreads, but you know what? I'm going to do this. So I would go and say, what if I sold 4 contracts of this, bought 2 contracts of this, sold another one of these, bought one of these, and I thought I was a genius. And then after all my mad scientist creations, I would look at the risk graph and I'd be like, oh, well that's very similar to a bull call spread. And so similar that it doesn't make any sense to do all these legs. It makes more sense to do a bull call spread. And it's funny because at first I thought I was going to create all these amazing, wonderful things, and then I found out that in the end it was very similar to one of the strategies that was very simple and easy to use with less cost and less complexity. So we're doing these sessions where we compare one against the other. There are going to be some differences, but there's also a lot of redundancy and overlap in the options world. So in this session, we're going to be looking at a horizontal spread versus a butterfly spread, and basically putting them up against each other and saying, okay, which one's the best? Now, if you can imagine which one the best is very situational, and we're going to talk about those situations in this session. But I will come up with a conclusion at the end of this to what I think is the best one, and you can take it from there. All right, so let's get into what we're looking at. We're looking at these strategies here. We're looking at any of the butterflies, call butterflies, put butterflies, iron butterflies, really all the same, versus a horizontal call spread. Now you can see that they all share one thing in common. They all benefit from time decay. They're all theta positive trades, meaning that when time runs out, it's going to benefit these. And you can see the risk profiles are pretty much the same. We want a stock to go sideways. If it has a big move one way or the other, it's a loss. So really similar in every single way except for this way right here, volatility. And this is really what we're going to get into in this session. But let's just take a look at these strategies side by side. So here we have the the horizontal call spread. And on the horizontal call spread, you simply have, I call it the tent. Now, I don't know if that's the right thing to call it, but I call horizontal spreads or calendar spreads the tent. To me, that looks like an old school tent, they put up that sags on the sides a little bit. So you have this tent area that is your profit window, and then you have these tails that go out. So again, if you don't know the horizontal call spread, also called the calendar spread, there's a whole session that you missed. Go watch that video. This is the butterfly spread. Just a different combination of options. Again, if this is your first exposure, I don't know how this would be your first exposure to the butterfly, but if you haven't seen the video, go back and watch the video. So basically, as you can see here, they're both sideways trades. And you can see this doesn't really look like the tent, but it kind of looks like the tent. You can see they're very, very similar. So when we look at these side by side, we look at something like a 140, 150, 160 butterfly, and we look at that versus a horizontal spread, we can see when we overlap them, we can see there's a lot of similarities between the price. So this slide is just the horizontal spread with a butterfly spread laid out on top of it. You can see we have the profit area is really in the center here, and the wings here control our risk. So question is, how are these different? How are these different? Well, let's take a look at the differences between the two. First of all, let's talk about the horizontal spread. And we're going to talk about the advantages versus the butterfly specifically. So some of the advantages that the horizontal spread has is it's lower cost. There's only two options. There's a long option and a short option. There's a long option that's dated longer than the short option. So as far as costs go, you now have less in commissions, and you now have less bid-ask spreads that you have to manage. So the horizontal spread, as far as costs go, absolutely superior when you look at just the cost of putting on the trade. This is a long volatility trade. And this is the big difference here. This is long volatility. So this means that if volatility increases, the trade is going to increase in value, which is a good thing for horizontal spread. Obviously, it's going to work the same way in reverse. A fall in volatility is going to hurt the horizontal spread. Now, if you want to take a look at any advantage that this horizontal spread trade has over the butterfly, is the ability to roll. Now, this is absolutely the number one reason why, if anyone said, Rob, I like these more, I like horizontals more than butterflies, this would be the only thing I could agree with them on, the ability to roll. So imagine that you have a 150. So let's go back to the example we had. We had the 150 calendar spread. So let's say we're long the November and we're short the October. So we're long the October 150 call, we're short the October 150 call. This gives you a lot of ability to roll. So let's say the stock ends up going up a little bit. You could roll this October up to the 160 and turn this now from a horizontal spread into a diagonal spread. So all you've done is, I call it, you've tilted. You've shifted the risk graph to where your horizontal spread looked like this. And all you've done is you've tilted it. You push this side down and you push this side up. So the horizontal spread gives you a lot of ability to make adjustments and a lot of ability to roll. And then again, you could keep doing this as much as you want. And also, when we talk about rolling, it's not just rolling to a different price, but it's also rolling to different expirations. So let's say that this option had weekly options. So this was the October 17th. So let's say you didn't roll up to 160. Let's say the stock ended up right at 150. You can roll this one to the October 24th. So as you can see here, you're just extending this trade another week. We roll this to the next week. We get some more premium the week after that. We could roll it to the November 1st. Sorry, that would be the October 31st one. No. It's November 1st. I've got my dates off for this year. So as you can see here, this gives you the ability to roll. And then if it goes down, you could actually roll down to the 145. And you could actually turn this to be slightly bearish. So this right here is the big advantage of the horizontal, is that you now have the ability, if you like to make adjustments, you get to make these adjustments. Really cool way to do this strategy. I use this on the diagonal call spread quite a bit to roll down or to roll up. I think it's a very great strategy to use. So this fits really nicely within that framework. Let's take a look at the butterfly spread advantages. All right, the advantages versus the horizontal. Now you do get a better profit area. And remember, I just put the butterfly on top of the horizontal. And remember, the horizontal has what I call the tent. The tent where it has kind of these drooping lines where it's, it's not exactly a triangle, it's more of a droop. Whereas the butterfly is going to have very straight lines. So you are going to get better profits inside of that window. The only places where it won't be the same is like right at the top. But you're going to get these areas are going to be more profitable. So when you take a look at the butterfly is going to be more profitable if it closes between your two legs. If it closes in between this spread here, it's going to be more profitable to be in a butterfly if there's no change in volatility. Well, we're going to talk about that here in a little bit. Speaking of volatility, you can see that this is short volatility. Right, so short volatility. Now, this is during the trade. Remember, at expiration, there is no effective volatility. If you hold the trade until the end and you don't sell it in between there is no effective volatility. None whatsoever, because it just all equals out at the end. It's only during the trade where you get these effects of volatility. So if you open up a butterfly and you want to close it out early, then yes, your profit and loss is going to be affected by the changes in volatility when you held that trade. If volatility goes down, then it's actually going to be beneficial to your trade. You'll make a little bit more than you would had volatility stayed sideways. If volatility goes higher, then it's actually going to hurt your trade. Another great thing about the butterfly is its max loss is clearly defined. It is clearly defined, meaning you can take a look at a risk graph and you know to the penny exactly what's going to happen. Like if you do a 140, 150, 160 butterfly, you know that at 139, you know exactly what your loss is. You know exactly what it is. That is not the case on a horizontal, because a lot of things can change. A lot of little variables and volatility can make this look very different. So the great thing about the butterfly is you can completely quantify your risk. Like, hey, I'm going to lose no more than $500 on any one trade. That is a guarantee on a butterfly, 100% guarantee. So let's take a look at a comparison. So I'm going to just take one trade, and I'm going to stack them up side by side against each other. We're going to take a look at the butterfly. We're going to take a look at the horizontal and see which one's best. So here is a Baidu 140, 150, 160 butterfly. All right, so here is what we're looking at. And you can see here the max gain on this is going to be right under $1,000, and the risk is going to be right around $1,000. So it's very clear. We know exactly where this is going to be at expiration. Now, this line right here, this line in the middle, this is what's called the over time line. And this is going to show us, hey, what's going to happen here in the next day or two. If we close this out in the next day or two, this is what the estimated line is going to be with no changes in volatility. But at expiration, we've got our very classic pyramid shape. Very clear, easy to define. We know exactly what our risk is. We know if it goes down, it's $1,000 is the most we can lose. And then we have our profit in here between 144.5 and 154.5. We've got a nice wide profit picture for this butterfly. Let's take a look at a horizontal. So this is long the October 1st, short the September 24th, 150 calls. So same thing, we have about $1,000 that we're going to be potentially profiting. So our max gain is about the same. Now our max loss, remember 140 on our butterfly and 160 was our max loss points. As you can see, this calendar actually looks a little superior. This looks like about a $850 loss at both of these points. And actually the upper point actually looks a little bit better. Maybe it's more like $750. So as you can see, it's short call expiration. This risk graph is for short option expiration. You can see that this actually looks a little bit better just for this week. we still have the same $1,000 profit potential. But at 140 and 160, we have better risks. However, let's take a look at what if it goes to 135, or what if it goes to 165? All of a sudden, now it's not looking as good. Now we've got about negative 1,200. So ultimately, this trade is carrying more risk. This is carrying more risk than the butterfly. So with the butterfly at 140, it was $1,000, and at 150, it was $1,000. Sorry, at 160. We have a little bit better numbers here. It isn't until about 138 and about 163 where the horizontal spread loses $1,000. So when we take a look at this, this is technically a better trade inside of 140 and 150. It's a better trade. It has a little bit better risk profile, but we have ultimately more risk if it goes beyond those levels. So if we take a look, here is the butterfly, and I'm just going to put over the diagonal. So I transpose this one. You can see here, very, very similar. So we've got this little bit of area, little shade here. This is where the butterfly is superior. It's going to theoretically make a little bit more money in here. It's going to be the same here. And then you can see that the horizontal is actually going to be a little bit more superior from here. The horizontal is a little bit better. Now it's a little bit better in the fact that you won't lose as much. It's not more profitable, it's just less. And then all of a sudden, we can see that just on the other side, once we get past those lower levels, we now see that the butterfly becomes superior again. But ultimately, at some point, those lines do flatten out, and we're probably looking at about $1,200-1,300 max risk whatsoever. So when you look at these, you can see they are very similar. They're very similar. There's a little bit of differences here or there. So if we're just looking at these and you're saying, Rob, with the information that you have right now, which one is superior? I'm going to say they're both. They're both the same. They're both the same. Let's talk about volatility, because this is where they are not the same. This is where we start to see some pretty big differences. All right, so I went ahead and just took these same trades and I said, okay, what is the effect of volatility? So I basically put in a 10% change of volatility. So we have four lines of volatility. So just to let you know how to read this first line is going to be minus 10% volatility change. The second one will be minus 20. Third one will be minus 30. The fourth one will be minus 40. So we can actually look and see, okay, what is the effect of volatility on these? And then the same thing on the upside. What if volatility decreases? Well, if it decreases 40%, you can see that that's fairly good for our butterfly. 30%, 20%. So I just want you to take a look at these lines, and this is telling you, okay, we're going to get changes in volatility. This is how it's going to affect your trade. So if you need to get out of a butterfly early, or you plan to get out of a butterfly early, whatever happens with volatility is going to affect your profit and loss. And you can see it's going to affect it somewhere between, plus $200 or minus $200. And in a worst case scenario, we get down to about minus $450. So we have this effect of volatility. It looks like anywhere from plus 200 to negative 400 is the effect on volatility. Let's take a look at the same effect of volatility on horizontal spreads. Sorry, I should say horizontal spreads. All right. I better put a Z on that. Actually, that doesn't help. I'll just have to spell it out. I thought by abbreviating it, it would look better. But then I'm like, no, just add the Z. And then I'm like, oh, nope, that's not any better. Okay. On horizontal spreads. All of a sudden, you can see Wow, what a difference. What a difference. We could theoretically have, with an increase in volatility, we have a $1,200 potential profit. And with a crush in volatility, as you can see, we're going to have about a negative $600 swing. All of a sudden, you can see that one of these trades is very, very sensitive to volatility. And that's really what I wanted to show you in this side-by-side shootout. As you can see on the risk graphs, calendar spreads are much, much more sensitive to changes in volatility. So yes, a calendar spread is going to benefit from a rise in volatility. However, when you see a rise in volatility, you also are going to see a bigger change in price movement. So think about that. You're in a position where a rise in volatility helps you. However, the position you're in, you need the stock to not go anywhere. Does everybody see the problem with that? Does everyone see that's a big problem? Like if volatility spikes, it probably means that there was a big drop in the symbol or a big drop in the market. If I'm at the money, then that is not conducive whatsoever to my trade. Yes, I'm going to get a bump up in the benefits of volatility, but if my stock drops from 150 down to 140, that doesn't help me. The bump up in volatility didn't help me whatsoever. So it's just not, it's not helpful. It's not helpful. So let's talk about when it is helpful. And we'll talk about that here in a second. But let's just, this is what makes them different. They're very, very sensitive to volatility. And if you think about, you're in a position where you want volatility to go up, but your position is, I don't want the symbol to go anywhere. That's, you're fighting two different fights. If you win on one, you lose on the other. If you lose on one, you win on the other. All of a sudden, it's not a real great profile to put you in. So let's talk about why the butterflies are superior. They are simple, and it's very easy to pinpoint your profit areas. With the horizontal spread and the changes of volatility, you can see that you could map that out. You could take a look at it and say, okay, well, I think it's gonna be in this area, but there's no way for you to understand or even predict what volatility is going to do. And all of a sudden, your risk graph can change. I remember years ago, I got an email from a trader that said, Rob, I think I'm doing something wrong because I got into a horizontal spread, and now it's showing me that I can't even be profitable on it. And when we pulled up the risk graph from where they got in now, that entire tent was below the zero line. So the tent was above, the top of the tent was above the zero line. The top of the tent dropped below zero. So his best case scenario was a loss if it went back to that point. It makes the trade really messy when you're saying, hey, I want to make a play on direction. I want to make a play that this isn't going to go anywhere. All of a sudden, all these other factors come in and make this a more complex trade. The butterfly is a very, very simple trade compared to this. You have everything locked in, and if you hold till expiration, it's really locked in. There is nothing to worry about with volatility. There is nothing to worry about whatsoever. This trade is short volatility, so it is in alignment. So we just talked about how calendar spread, you're long volatility, but you are neutral on delta. Totally different tugs and pulls going on. This one is in alignment. If you think the symbol is not going to go anywhere and you open up a butterfly, if that works, there should be a drop in volatility. If the symbol doesn't go anywhere, there's likely going to be a drop in volatility, which is beneficial to your position. So all of a sudden, we're now making a trade that's in alignment with both our call on direction and our call on volatility. And the nice thing is you can completely count on what your P&L is going to be. at expiration. Now, even if you hold a horizontal spread to expiration, to the short call expiration, we have no guarantee that you're going to get $1,000 at your max gain point, because that long volatility, so your short call, all the volatility, all the vega in that is gone at expiration. That's gone. However, remember, you have the October 1st. That option is still there. And to close the whole position out, you're going to have to close that position too. And whatever volatility did to that position is going to add to or take away. And if it's at your max gain point, it's likely taken away, because that means there hasn't been a whole lot of volatility. So we don't really know. We know exactly to the penny what you're going to make or lose on a butterfly. You don't know that. So it's very difficult to kind of plan out what your P&L is going to be using horizontal spreads. And your max risk, you know what your risk is. It's very simple. There is ultimately going to be a max risk on horizontal spreads, but that's really far away down the road. So as you can tell here, I'm definitely leaning harder towards the butterflies. But let's talk about when a horizontal spread makes sense. So a horizontal spread makes sense as part of an adjustment strategy. So when I use horizontal spreads, one of my rules is I can roll a diagonal down if certain things happen. So let's say I've got a diagonal call spread. Let's say I'm in the 150, 155. And let's say the stock isn't as strong as I thought. I thought the stock was going to close at 155. Let's say it closes at 151 on my short call expiration. I still like the trade. I still like the chart. But I think it's just going to be going sideways for a little bit. I can roll this down to a 150 for that next week. That's going to bring in, let's say, $3 or something. That's just going to lower my cost basis. Now, look, if that stock takes off, that was a bad adjustment. But all of a sudden now it gives me the ability to adjust this trade. So as part of an adjustment strategy, horizontals make a ton of sense. It also makes sense if you want to make a long multi-week trade. Now, we do have traders that do this, and they do very well at this, is they buy a longer dated option. So let's use an example of, let's say it is September at the moment. They may go out and buy a January. They may go out and buy a January 150. Now remember, on the horizontal spread, you are getting the difference between how fast the short, so again, let's say you do a September 150. You get the difference of how fast these ice cubes are melting. They're both melting. So let's say you hold this trade for 5 days. Well, your September option had 5 days till expiration. You held it for 5 out of 5 days. You get 100% of the time decay. All the way to January, you held for 5 days out of 125 days. So that is going to be, I won't do a percent here. Again, you're going to lose like 3 to 4%. 3 to 4% on this. As you can see here, going further out makes a lot of sense, because if you just went out to the Octobers, you might have lost 25% of the time decay because it's a shorter dated option. So for people who wanted to do this longer term, where they're just saying, hey, you know what, I just want to be short theta. I want to collect premium. By going out and buying longer dated options, it really helps this whole thing out, because again, it's melting very slowly on a percentage basis. And it allows you to just simply sell these options. So if it stays at 150, you can do it for the next week for 5 out of 5 days and get 100% of that. And again, during that next week, maybe that option, your long option, melts 4 to 5%, speeding up a little bit. And then again, you could actually then, let's say you roll it up to the 155. Now you get another 100%. So as you can see, if this is part of a strategy where you're saying, hey, this is my game, I'm going to just sell short-term theta. I'm going to have this long-term option, anchoring it and hedging it out. I think it's a great strategy. And we have traders that do it very, very well with this strategy. Now, I've got not many other reasons. I actually have one other. I have one other trade that I think makes sense for horizontal. And that would be for an out of the money horizontal put spread. Now remember, the put spread benefits from a drop in volatility. So let's say that I wanted to be really bearish this certain stock. And so let's say that stock's at 150. And I say to myself, I think this thing's going to have a big drop. Now, yes, I could buy puts. Yes, I could. There's a bunch of other strategies that I could do that probably make more sense. And so this is one of those that this makes sense to do this, but there's better strategies out there. But let's say that you say, you know what, I think the stock's going to have a big drop. You could do the 120. And what that's going to do, that's going to be a very big tent because, again, you're way out of the money. So this is going to be your trade. This is 150. This is going to be 120. As you can see here, if it goes into that area, it's going to be a really big risk reward. Plus, if this stock drops 30 bucks, what do you think has happened to volatility? You're right. Volatility has probably shot up as well. So this is the risk graph at expiration. If we want to add in, what about if there is a 20% rise in volatility? This risk graph could look something more like this. It could look even better with the drop in volatility. You can see your break-evens could be really close here. And if you have an order, say, hey, close it when it gets to 120, you're going to close it and lock in that gain with that big volatility. So this is a strategy that makes sense. I have, again, some traders that do a lot of stuff, a lot of bullish stuff at the money. So let's say that you've got a whole bunch of bullish trades here. You could put one of these trades down below on something like the spiders. It's a very cheap trade. And so let's say you've got all this bullish delta, and let's say the markets crash. This gain could cover all the losses that you took on all your bullish delta that was closer to at the money. So I've seen some traders use this as a hedge. Again, it's a very, very cheap trade this far out of the money. And it's just one of those insurance contracts of if we get a big drop, that's going to cover all the losses I take and probably more on my bullish at the money stuff. So as you can see, there is a time and a place for it. It is definitely a more difficult trade, a much more complex trade than the butterfly. But there's really not many other reasons. If you were going for a pure trade on no direction, and that's all you want to play, you don't want to mess around with anything, the butterfly. The butterfly is absolutely superior. So let's wrap this up here. Both strategies are profiting from decay of time value. Really the only difference between the two is the effect of volatility. And because if something is stagnant, you'll see a drop in volatility, it pretty much says the butterfly spread is superior. There's a few times where the horizontal spread makes sense. We went over a few of those. But if you're looking to make a pure play just based on direction, pick the butterfly. It's the superior trade every time. Hey, thanks for joining me, everyone. Take care. Bye.